Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me typically would be the man himself, the governor of Beckerville, USA, Mr. Michael Becker, but he is on another due diligence assignment with his company and friends over at SPI, and we wish him a lot of luck. And so you just have me for today and talking to some of our friends. So before we get going, I just want to remind you that coming October 4th and 5th, to Dallas, Texas. We have the Old Capital Conference. The Old Capital Conference, that's our once a year large mega conference. We'll have 500, 600, 700 people show up for that, investors throughout the nation. And I believe our guests have come to it maybe every year or close to every year. And so we're excited to have you come to the Old Capital Conference. Again, this is for investors. This is for syndicators. This is for people that want to know more about investing in apartments, about what's going on. It's just not in North Texas or in Dallas or in Fort Worth. It's for every place, just listening about what's going on. So go to oldcapitalconference.com, oldcapitalconference.com. Get more information, RSVP. It is a 2-day event, half a day of getting to know people, networking, drinking. And the second day is more education and more being part of a larger group and seeing about what's going on. So October 4th and 5th, we will see you then. In the podcast today, we have some friends of ours that we've known for a long period of time. In fact, I've known their father longer than I've known them. So in the podcast today, we have the group at Rowan Multifamily Advisors. Rowan Multifamily Advisors. In the podcast today, we have Rowan Birch. We have Colton Birch. We have Matt Waskow. And then we have a lot of guys that couldn't be in the podcast today. We're missing Pete Hartnett. We're missing Bradley Birch. We're missing Connor Martin. And so we'll miss them today. But I want to have you listen to some of the things that I call my three amigos that really have some great inside information about what's going on in multifamily real estate, whether it's brokerage, sales, finance, just the general tone of the market right now. And so I'm going to start off with Rowan. Rowan, how are you?
I'm doing well today, Paul. I'm very flattered that we're three amigos here with you. I appreciate you giving us that honor.
So Rowan, again, part of Rowan Multifamily. And Colton, his brother, is part of Rowan Multifamily, and Matt is part of Rowan Multifamily. But Rowan, how was the company named after you? I mean, this is a question I've always asked myself. How did that happen?
It's a fair question, Paul, and it's one that I get probably every meeting we sit down in, but I still haven't got the perfect answer to it yet. But really, Rowan is my mother's maiden name, and my dad and Colton, when they were starting the company, they had used Rowan in different usages for different companies in the past, and it just kind of came up as the first choice, and then it snowballed into the company it is today. So I definitely get a little bit more calls back when your name's on the company, when you're doing some cold calls, but it's just a family name that was unique and one that we used to start the company.
That's great. That's a good piece. You talked a little bit about your father. And so I've known your father, I'm going to say almost 30 years. And he's really a legend in the multifamily space in the Dallas-Fort Worth marketplace. I mean, this guy, extremely knowledgeable. He started off is in brokerage. He worked for some of the largest multifamily brokerage companies in the United States, did a tremendous amount of business. And then a couple of years when the boys started to get to an age, he decided to open up his own company. And him and Colton and Rowan and now Matt, that's joined, and Pete, of course, they formed Rowan Multifamily. So they've done a great job. And it's a blessing to have somebody within your family so damn knowledgeable about what's going on. I'm sure that you have to ask them questions all the time about what did you see in the 1980s? Is that kind of reflection of what's going on these days? Colton, talk to me a little bit about your father's experience in multifamily.
Yeah, Paul, thanks for having us and the kind introduction and the kind words. But yeah, no, we definitely have just pinged his brain a little bit recently about these rise in interest rates and comparing it to the 3 or 4 or 5 down cycles he's seen in his career over 35 plus years in multifamily real estate. And so we are very fortunate to have his knowledge. But yeah, he sees a slowdown. There was a lot of money pouring into DFW, and there still is, just because of the growth of Dallas-Fort Worth Metroplex and all the fundamentals that are taking place here that make investors want to come and renters want to come to Dallas-Fort Worth. And so, his thoughts are, hey, this is just a reminder to all of us that when you're underwriting a deal, when you're going into buying a multifamily property, you want to be the most aggressive offer and win the deal, but also you need to look at all the factors, and, fixed interest rate loans really is a positive way to go, at least for the short term in a lot of situations. Because when people are getting in trouble in this market, it's really if they have floating rate debt.
Yeah. And then Colton's been in this business for a long period of time. He started off in 2011 when they formed Rowan Properties. And then Matt, you're graduated of UNT. You started off as a financial analyst in 2013, and you transitioned over to the brokerage business. So I'm going to ask you this question, Matt, is that tell me a little bit about you guys. I mean, do you guys have geographic areas that you work? Do you work Fort Worth? Does Rowan work Dallas? Tell me a little bit about how the company's broken up to handle all the business that you guys do. And you guys do a tremendous amount of business.
Yeah, thank you, Paul. Appreciate the time on the podcast. And that's a good question. So Colton, Rowan, myself, I would say neither one of us really have a specific niche regarding area. We all focus on DFW predominantly. We've also done some business in San Antonio, and then kind of reaching out west to Abilene, east to Tyler Longview, and north into Oklahoma. So we try to cover all of it. I have, not by selection, I have tended to do a lot of secondary market business. So I wouldn't say that I am the secondary market guy, but I happen to do a lot there in the past couple of years. So we think that there is enough product in DFW that, at least at this point with our team size, we can try to tackle it all.
Absolutely makes sense. Okay. Let's get to the meat and potatoes of our conversation. Let's talk a little bit about the North Texas apartment market these days and really what's going on. So Rowan, as an umbrella overview of the market, what's your 2 cents?
Yeah, I'm happy to give that, Paul. So that's the question we get on every call. Everybody's calling and trying to figure out what's going on and where we are exactly in the market. So obviously 2021, 2022, the market was red hot. Interest rates were very, very low. Most buyers, I think about 90% of the deals we sold in those years were using bridge debt, and that bridge debt had floating rate loans on it. So what's happened is obviously interest rates have gone up very quickly over the last 12 months. We've seen that pricing, cap rates expand, price per units go down. And that in turn has slowed down the market. So the market is down in DFW for B and C class assets about 75% first half of 2022 versus first half of 2023. So we've seen a significant slowdown just because of the rapid cool in pricing in the market. There are still deals happening in DFW. It's still one of the best markets in the country. I truly believe that. There's still very strong inward migration and population growth. However, it's definitely been a slower market than the last 2 years. And so, it's a big change for us, quite honestly. I mean, we're used to a ton of volume in Dallas-Fort Worth, and we were one of the top markets the last 2 years, and it's slowed down pretty significantly.
Colton, anything to add to what Rowan was saying about what you're seeing out there too?
Yeah, absolutely. It's it's a time right now where a great time for new investors to sweep in and, buy some of these properties that had been bid up substantially the last couple of years at a discounted price. So we are seeing, discounts to the last couple of years, and, the number of buyers that are coming to the table on each deal right now is quite a bit less than it was even 15, 18 months ago. We are seeing a lot of some newer buyers coming to the table and trying to make sense of these deals. And really, I think the model that people are taking is, a little more conservative model. They're trying to set the expectations of their investors to a, moderate expectation. The idea of doubling your money every 2 to 3 years in real estate, multi-unit real estate is unrealistic. It's unsustainable. We've definitely seen a big growth in these new investors coming to the market.
Matt, what's your 2 cents? We talked a little bit about some of the out of state. Are you starting to see a lot of out of state buyers coming into the Dallas Fort Worth market, or is it just everybody from Dallas is buying stuff in Dallas?
Well, I would definitely say that the players have changed. Your top buyer from 2021 or 22 is probably not the top buyer this year. There are a lot of new groups coming into the market. And there's also a lot of groups that have been in the market for a long time, but maybe have been inactive towards the top of the last cycle that are getting back into the market now, getting active again at reduced price points. And there's a lot of smart people that are investing right now that see a lot of value here that I tend to trust, their opinion. They're putting their money where their mouth is for their opinion and buying deals right now. So it's just a challenging environment. It is not algebra right now. It is calculus to get a lot of deals done. There's a lot of moving pieces from equity to debt to just pricing expectations aligning between buyer and seller.
That's right.
However, and that there's opportunity.
So let's talk a little bit about, deals that are actually being done, and without naming names, Rowan, Colton, Matt, without naming names, let's talk about 2 or 3 of your recent deals that closed, and what are investors buying these days? Are they buying a 300 unit building? Are they buying a 200 unit building? Why are they buying? Let's talk a little bit about, again, without naming names, just give me some profiles of who's buying these days.
Yeah, this is Colton. I can take that to start with, at least. Paul, like you said earlier, I've been in the business since 2011. And so I've seen this market, heat up to get super hot, to cool down what it's at now. But, what we see right now is institutions are very difficult right now. Either they're pencils down or they're very selective on the deals they come into. Therefore, it is a lot of syndicators that are still trying to raise money and raising money from individuals or small family offices. And that's where a lot of the money is coming from. But it's a slower process these days. And sellers have to understand that, as they need to give buyers more time than they used to have to give them even 18 months ago. And buyers need to ask for a little bit more time to be able to raise the money and close deals, because it is more difficult these days. But I would say everybody, and I've had this conversation a lot recently, everybody's dialing back their price point. If you were a buyer in the last few years at $20 to $40 million deals, you've probably dialed that back to $10 to $25 million deals, $10 to $30 million deals. The equity requirement for these deals is greater than it used to be, and the raising money is a little more difficult. And so that is allowing or requiring people to kind of scale back to a little bit smaller deal than they would have maybe pursued before. A recent deal I closed, was one out in North Texas, and it was out in Sherman, actually. And that deal, it took about 120 days to close that deal. And it was just a well-located B-class asset. And I believe those buyers, I think they put fixed rate debt on it. And I believe it was fixed rate bridge. But yeah, that's a little bit about what's going on.
So why did the seller, before we jump into Matt here, why did the seller want to sell that property? And when did the buyer want to buy that property? What was their thinking today?
Yeah, that's a great question. That seller had owned that property for a long time. I think about 6 or 7 years. And that's a long time for this market when a lot of deals have been turning over every 2 to 3 years. And so, I think what the value that seller saw, even at discounted pricing, was that seller goes, hey, I can still sell this building at an aggressive price today. It was much less than it was 18 months ago, 24 months ago, but still give a solid return to my investors, and you can't look at what the property rose to value in but what you bought it at and what the return for the investors are. So I believe that seller still gave about a 15 IRR to his investors, and he was happy with that, and they were happy with that, and they were happy to just move on to the next asset and take their cash with that return. And then the reason the buyer bought that is just it was a well-located asset with rents that still had room to move up. And that's, it's a location that's going to, grow exponentially. So
Yeah,
that's
Sherman, Texas is kind of a story property in that area because TI is putting in $16-17 billion into its new semiconductor chip factory over there. And so this was an older asset that the buyer said that, this is an opportunity to buy a good quality older asset. Not everybody's going to be able to afford $2,000-3,000 a month, but the people that, maybe that workforce housing that can afford $1,300, $1,400, $1,500 a month, that's who the tenant is on that property. So they saw that as an opportunity to move in and capture the flag on that one. Again, they did put down significant cash into the deal. Yes, they did a bridge loan, but they were going to do a bridge loan to fix the property up and then get out of the bridge loan and go to Fannie Mae financing. So they put enough cash down that there would be in a good position to do Fannie Mae financing in the future. Matt, tell me about one of your deals that perhaps you closed recently that could give us some inside information.
Yeah, another good example is a townhome property in Garland we closed recently, a little on the smaller end, closer to 50, 60 units, very large units with garages. So the rent rates compete with single family homes and other kind of SFR product in the area. And it was a loan assumption. It was bought by a group in a TIC structure. So there were 5 principals, each bringing an equal amount to the table, assuming a Freddie SBL loan at a below market rate. And it was owned by a mom and pop operator out of state who had to infuse a lot of capital into the property due to the ice storm in February of 21. And therefore, the property's condition was excellent. However, the operations were poor. So they found a lot of value in that story and in the quality of the product. And I've done, these are repeat clients that we've done 4 or 5 deals with. And they're transitioning their portfolio to the kind of similar to SFR style townhomes in well-located suburbs in DFW.
I love it. Closed within, you did an assumption. So how long did it take for that to close? And especially a TIC structure is usually a little bit more complicated. How long did it take to close?
It took right at 90 days.
Okay.
So, which I'm told is a little bit less than some other assumptions right now, but it went very smooth, it's, which is all you can hope for in today's market.
That's all you can hope for. That sounds good. Rowan, finish us off. Just again, out of sight, out of mind. Don't go in the specifics, but tell me like a recent transaction you've closed in the last, say, 60 days or so.
Yeah, I'll give one with a little bit different perspective than the last two. So we had a deal we closed recently that was owned by actually a fund, and the fund had bought a significant amount of assets in 21 and 22 between Dallas and Florida. And this one they purchased back in 2017, 18. And they really wanted to get, a good win on the books because they knew down the road there was potential capital calls coming or they were going to have to, slow down distributions to investors. And so that was an asset where they hit their return metrics. They didn't get the pricing that they were expecting 18, 24 months ago, but they wanted to get a pelt on the wall, so to speak, with that deal. And the buyer was a syndication model that used agency financing, similar to the other 2 groups other 2 closings that were mentioned. And we've done, I think we've still seen strong syndication groups that have really strong sponsors step up, purchase good deals, get their equity together quickly and close in good time. So that one specifically closed in about 60 days.
Congratulations on all those wins for the Rowan Multifamily Advisors team. Tell us a little bit about some of the challenges these days for owners, whether it's selling a property, holding a property, or even buying another property in like an exchange. What are you seeing right now, Rowan? Let's go back to you on some of the challenges, and it may be that they're right at their end of a maturity when we're talking about some of these bridge loans that are coming to an end, because, these bridge loans are not 30-year fixed rates. They're not even fixed rates. They're like three-year fixed. No, they're not 3-year fixed. There's 3-year adjustable rates. And then you possibly have 2 1-year extensions. Wait. You may only get the extensions if you hit certain hurdles to get the additional time into the deal. So they can become very complicated for a lot of groups. So what are you seeing, Rowan? I'm going to go to Matt next. What are you seeing for some of the challenges some of these ownership groups have these days?
Yeah. I think you kind of hit on the main one that we're seeing right now, Paul, is a lot of these groups that bought in 2021, they put 3-year adjustable rate bridge loans on their assets. Those expirations will start coming up in 2024. And one of the biggest thing that's happening right now, month by month, we're seeing it, is you're having to escrow for a new rate cap, a new cap on your adjustable rate mortgage a year in advance from that cap expiring. So if you have a cap that's expiring in March of 2024 and you purchase the property in March of 2021, you're having to start escrow for that new rate cap purchase a year in advance, which cuts into cash flow pretty drastically. And so, even though we've seen people that have hit their business plan and do really well with the asset and meet their pro forma rents, they're still having to, kind of stop distributions because they're seeing these massive reserves they're having to put up for these rate cap purchases for the next year. That's definitely one of the biggest things that we're seeing right now in terms of just some struggles that we're seeing with some owners.
Matt, what are you seeing out there?
Well, another challenge facing owners right now, Paul, is the expense growth. Taxes and insurance. Kind of to add to your debt challenge, you may have a floating rate cap expiring. Well, you've also got significant tax readjustments going on across the market, as well as insurance. So there's a lot of headwinds that sellers are having to overcome and factor into their decision-making process. So if they are getting a BOV, and we're seeing a lot of people right now assess the market value of their property, those things have to be taken into account because a new buyer and a new lender are going to factor those things in and adjusted insurance rate, increased taxes.
So what are you using for when you underwrite these deals? Again, people bring you the financial statements of their property and they want you to kind of determine what the value is of the property. It used to be insurance on a per unit basis on an annual premium was like $350. What is insurance today? What are you guys underwriting to? And probably property taxes too. Are you using 90%, 100%, 110%? What are you using for property taxes? It's just as a rule of thumb, guys.
Well, for insurance, Paul, we're seeing it range from, maybe 700 on the best case to sometimes north of 1,000 per unit. What we've been doing is really trying to firm up these kind of high level analyzations on the insurance and get actual insurance quotes, get soft quotes from carriers. Some other creative things that we've been doing to try to mitigate this is check with the current insurance carrier and see if they will allow that policy to be assumed. And if it's a Fannie to Fannie deal, a Fannie loan is being paid off, new buyers getting Fannie, will those insurance requirements be the same to try to mitigate that? Because if you go to market, it'll be higher. So, rule of thumb, I think would be 750 to a little over 1,000, depending on the asset class, age, location. And then, Rowan, what do you think on taxes?
Taxes is a tricky one right now. I'll just give a little anecdote here. So we had a couple deals under contract when the 2023 values came out back in April. And because cap rates have expanded in the market and taxing authorities are still being very aggressive, we had 2 deals where the assessed value in 2023 was significantly higher than the purchase price that we had these deals under contract for. And so that created and posed a problem that we had to kind of creatively get through with some more time. But from what we're underwriting on taxes, it really just depends on their current assessed value. But we're definitely having to be a little bit more conservative on our tax underwriting. We're probably 85 to 95% on our deals right now.
That's great. Colton, last 10 years, we've seen a lot of transactions close within the syndication model. As you know, a syndication model is like an airplane. You have a captain in the front of the airplane, and they're like the general partners, and the passengers in the back of the airplane, they're the limited partners. But guys, are we seeing too many captains looking for an airplane and just not enough passengers wanting to fly? So Colton, what's your 2 cents in the state of the syndication model these days? Are the limited partners still investing in these deals?
Paul, that's a great question. Yes, limited partners are still investing, but they're being selective on the general partners, the pilots that they invest with or fly with, yeah, so to say. And I think that these limited partners have a lot of money, spread out through other asset classes and are trying to allocate some toward multifamily and just trying to figure out who they can trust in these times that are just uncertain, with the interest rate environment and the economy and such. But, the dynamics of DFW are continuously strong. And I think that that's a story that a lot of people are just continuing to mimic, just saying, hey, DFW is the place to be long term.
What are we, and guys, what are we advising sellers these days? Is it time to go? Is it time to sell these properties? And I guess it depends if you have a maturity coming to the back of your head, so to speak, like in the mafia. Is it time to go? And then everyone spoke about rescue capital to keep these properties going. If partnerships were not able to raise money, have you seen any rescue capitals coming in? So what are you advising sellers? Is it better to try to sell it now versus a year from now? And are you starting to see any rescue capital come in, or is that just the head fake?
I'd like to start with that. This is Colton. I'd like to start with that on this, what we're advising sellers at least. But, we would tell sellers that, hey, if you've got a fixed rate Fannie Mae loan and tons of IO left, and that you probably should hold on. You should probably hold on at this point. But if you've got a maturity coming up or IO burning off or a big CapEx need that is coming soon, then you should probably consider a sale. But also the fact that, hey, if you bought in 2018, 2019, and you still have a good return IRR you can provide to your investors by selling now at today's prices, then that still might be a great move to do. Sure, it's maybe not a 25 or 30 IRR, and maybe it's a 17 or 18 IRR right now, but that's still something to be proud about, and the investors should be happy with that return. And so I think that's one comment. But then also I'd like to answer the question about operations a little bit as well. These costs continue to rise for labor costs. We are advising that if people want to hold on, that they, really focus on the tenants and, raise rents slightly, but really focus on trying to retain tenants. The turnover costs are more and more expensive as labor costs rise. So that's what we're advising sellers or possible sellers.
I think that's very prudent advice, Colton. Thanks for sharing that with us. I mean, that's why you go to Rowan Multifamily Advisors for the advice. I love it.
Well put, Paul.
Yeah. Matt or Rowan, any additional comments concerning the syndication model these days?
Yeah, I can touch on it just very, very quickly. I think, one of the things that we're telling sellers right now as well, every deal is different, but some sellers are telling us, hey, my occupancy's dropped a little bit. I need to get it back up before I go to market. And I would say we definitely think if it's possible, you should get your property in an agency qualifying position before you take it to market. 75% of the deals we've done this year are agency financed, as opposed to last year when 90% were bridge financed. And so that's one of the big things that we're looking out for on the deals we're underwriting is make sure you're agency eligible for a new buyer to come in and put fixed rate debt on. And that seems to be the way the syndication model is trending, is they want, these LPs, they want to see some stability. They want to see fixed rate debt. They've heard, horror stories about floating rate, and they want to see some fixed rate, long-term conservative business plan and underwriting.
Matt, anything to add to that?
Yeah, also to add to that, Paul, some of the things I'm telling, because we do have some clients that are maybe not immediately in distress, but maybe not in the best situation or where they thought that they would be with an asset 1, 2, 3 years into it, with loans maturing in the near future, is that, hey, for one, this is not personal. There are a lot of good operators out there that have been trying their best and they just cannot keep up with the headwind. Hey, there are institutional banks collapsing. Okay, this is not just a you problem, it's a market problem. Live to fight another day. There's a lot of folks that own a lot of real estate here that in the last recession may have had a couple of lemons in their portfolio. So, make out the best that you can and, live to fight another day. If you're in a position to, hit a base hit or even a bunt or even just go back to the dugout. Sometimes that can be a better opportunity. And for those that are stabilized with fixed rate debt, Colton's correct. If you're in a position to hold, by all means, I mean, that may be the best option, unless you've got interest only wearing off, or, maybe you're cash flowing only because operations are exceptional right now. If there were any sort of mishap in operations, that would hurt you. So I would tell those folks, if you're stabilized, but you think something could change in 12 months, it would be better to do something sooner than later. I don't think anyone has a crystal ball for the time period, but I do expect in some point in the future, we will see more distressed market properties hitting the market that may have some temporary downward pressure on stabilized prices.
Let's talk a little bit about some of the stuff that's in the newspapers or the rags that are concerning multifamily operators, especially these large syndicators that have bridge loans maturing. How concerned are they, and what are they doing to solve their problems? And I'll ask that question to the guys here in a second, because as a banker, I've always said, when you owe the bank $1 million, that's your problem. But when you owe the bank $100 million, that's their problem. And so, a lot of these syndicators owe a lot of their bridge lenders a lot of money. Are you starting to see them coming to the maturity here? Are they talking about knocking on the door like a wolf and trying to take the property back? Or are they talking about just giving them some extensions to loans? What are you hearing from some of these large syndication groups, guys?
Paul, this is Colton. Yeah, I would say that the bigger the fish, there's some really big fish out there of syndicator groups that we've talked to that, say that their lenders are working with them. They're not going to be able to fix their problem and fix the market, but they are working with them. No one wants to see a large domino fall or multiple large dominoes fall in this business, and so even the lenders don't. And so they're working with them, kicking the can down the road, tacking fees on the backside to give them extensions and just, buy them a little bit of time. But at the same time, not everybody's going to qualify for that treatment. And so we definitely see plenty of rescue capital on the side, ready to come in when necessary, but that hasn't really played out fully yet.
No. Rowan, Matt, any other comments on that?
No, I think Colton kind of nailed it. I think that's what we're hearing from a lot of these larger groups, and the rescue capital front. We've definitely had a lot of groups that were buyers in the last in 21, 22 that have come back to us and say that they're willing to provide rescue capital for certain groups. And so I know that there is that avenue out there, but like Colton said, we have not seen it come to fruition quite yet. Not saying it won't, but not at this point.
Matt?
Yeah, I think they pretty much covered it.
Okay.
So far, I think DFW may be a little bit more insulated than some other Texas markets on the distress front. But capital calls, rescue capital, a lot of these conversations are ongoing right now.
Yeah. So let's talk about opportunities, and let's talk a little bit about the good news that's out there. At least it's coming. We've handled give you some answers on some of these difficult questions on maybe some of these maturities that are coming here soon, that people may be losing their properties. They may not be wanting to stay in multifamily. And for new and coming investors, let's talk a little bit about the good news. And it can be just a broad topic. So what are you talking about these days to some people that just want to get into the multifamily business? Rowan or Colton or Matt, what are some of the positive things, whether it's DFW or it's the Texas, explosion of positivity in economic numbers? I mean, talk to me a little bit more about what's the positive word out there?
Yeah, I could start. I'd say, Dallas Fort Worth is very uniquely situated, where we have, extremely business friendly state. We have an extremely diverse economy, and we still have some of the strongest population growth in the entire nation. All those things are still fueling DFW rent growth. We have not seen that, revert to negative rent growth by any means. So that's definitely a positive thing. And then I also think from a good news perspective, there's going to be a lot of opportunities out there. There's going to be, I think, on both fronts, both strong basis plays where someone can get in at a really good basis on a deal and be in a very strong position there. And then also, on the deals we're underwriting, the cap rate expansion has been pretty drastic the last 2 years. So our buyers want to see positive leverage. So the cap rate above the interest rate in year one, right? There has to be a clear path to that solution of the equation. And so, that's what we're underwriting to. And we're seeing, a lot of sellers come to grips with that. And so I think that we're back to fundamental underwriting where deals are going to cash flow in the first couple of years. And I think that those opportunities are going to be a very well received by the market, that we're going back to fundamental underwriting and looking at, these deals on a stabilized kind of interest rate outlook.
Yeah, it's to add to that, Ron, it's back to the basics. This is how Mike in his career grew up knowing and doing the business and taught us in the beginning. And what we're seeing for the opportunity front is on the basis and cap rate side of things, a few properties that are available for not even pre-pandemic, price points and cap rates, but 2015, 16 cap rates and price per doors due to the situation the seller may be in. And that is phenomenal because the rents have grown so much since then. And there's still a lot of operational upside in the market. Things were very hot. And I think that asset management was not taken very seriously within certain groups during the peak of the market. So there's a lot of opportunity for sweat equity to come in and get a great going in return. And maybe with little effort, just a lot of attention, go boost that value a lot in a short amount of time.
Any other comments, Colton?
Yeah, Paul, I would just say that, there's still a lot of excitement around DFW and the companies coming here, just across the board, and just, the money follows where those companies go. And that's where tenants want to move to, and that's what they're going to be. And so, we're just very excited about that. But like the guy said, cap rates have come up, and, all indicators point that, hey, these interest rates are going to come back down. No one has a crystal ball to know if it's 6 months, 6 years, or, 18 months. No one really knows, but they are going to come back down at some point. And so, you're buying at a cap rate right now that, hopefully you can sell into a declining interest rate environment and really maximize your value in a few years and a couple of years. So there's positivity behind that. And I think just everything, when we talk to clients in New York and California and some of those other states in the West and East Coast, and they tell us about rent control and some of the bigger issues that are going on there that are even greater and more detrimental than the rising interest rates and rising costs there, they go, that is going to drive more money from the West and East Coast to Texas, just the freedom, the business friendliness here in DFW.
Two things, and we'll finish this off here. One of the things is that I always get is why people use Rowan Multifamily Advisors. And it's really, there's a lot of brokers out there, but it doesn't really make a difference whether you use XYZ broker or ABC broker or Rowan. We like to think Rowan does a superior job in trying to put together a marketing profile of the people out there. But when they bring out a property to take a look at, and it's a high quality asset, they may have 300, we call them CAs. And again, what does a CA stand for, Rowan, real quick?
Confidentiality agreements.
That's it. So they may have 300 confidentiality agreements signed when they put it onto the market itself, and they may have 30 or 25 or 30 tours of the property, and you may have 15 or 16 actual offers that come in on the deal. And that kind of tells the seller what the market is like. And so they take those offers and they put them into a spreadsheet, and they share that with the seller about what's going on into the market itself. So brokers don't really create the market. They're a reflection of the market about what is going on. And everyone thinks that it's going to be an oddball duck out there, that some buyer is going to come in and offer them a 2.5%, 3% cap rate on the deal. That's not going to happen. That doesn't happen. They may go under contract for 30 seconds and all of a sudden they'll blow themselves up and they won't go forward on that one. That's just somebody that's unrealistic until they find out that they can't get financing on the property to what they expected, and it just doesn't work. Colton, any comments on that one at all?
Well, we appreciate the kind words, Paul. And yes, we like you said, we're just a reflection of the market as we put deals out. We have the same databases that any other brokerage has, and they have the same ones we do, from CoStar to Yardi and everything in between. And so we, Real Capital Markets and some different sources that that are out there that allows us to get these properties we market out nationally to buyers across the country and across the nation and across the world. I mean, everywhere. So, we really value that, and we value sellers, and we understand the position they're in. Rowan and I have passively invested in a few deals, and we understand what that looks like and the concern they have, general partners have for their limited partners and the return. And so we really value ourselves on our long-term knowledge and experience of how properties operate. And, I think we add value in that aspect.
Yeah, that's the second point, is really showing value. There's a lot of people that take the philosophy that they can push out something through the mail of something that says, Dear XYZ LLC, I am an interested buyer of your property on blah, 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 and I would like to make you an offer, blah, blah, blah. And, they just send these things out willy-nilly to possible sellers that, they're fishing in really the wrong holes. And if you listen to these guys over at Rowan Multifamily Properties, they're assassins. I mean, they don't have a shotgun approach. They have the rifle approach. And what that rifle approach really means is that they know who the buyers are and they know who the sellers are. So when you're thinking about trying to buy a multifamily property, don't try to send out a bunch of these legal yellow pages to go out there, or something that's typed up or just handwritten out to a bunch of LLCs. When you listen to Colton, I mean, they call him the honey badger for a reason, because when he bites something, he stays on it. And I can't tell you how many outbound calls that he makes and the relationships that he has on behalf of Rowan Multifamily Advisors, that you trying to send something out to hopefully find somebody that's in a level of distress to have them buy the deal. I don't recommend that at all. Go through the professionals, get it done the correct way. Listen to the guys at Rowan Multifamily Properties. Again, guys, if people want to get a hold of you guys, what's the best way for them to get a hold? I'm going to start at Colton. What's the best way for them to get a hold of you?
The best way for them to get a hold of me is to reach out to me on my cell phone. But, send us an email, Colton, COLETON at Rowan, ROWAN, multifamilyadvisors.com. Either one of those. We have a website, rowanmultifamilyadvisors.com. Would love for y'all to visit the website, see the deals we're working on that we've closed recently. Like Paul said, we've got relationships across the city and across the state of sellers, and we'd love to share any market information we can on the rent side for owners, or expense side, or whatever we can help sellers trying to find what to do with their deals. We'd love to help you guys. And so we have a board in our office. We track all the exchange buyers that we can that are looking for deals, multifamily deals in Texas. And so, exchange buyers are really valuable right now, just with them having the money in hand ready to go. So we'd love to help.
Matt, what's the best way for them to get a hold of you?
Yeah, via cell phone or email at Matt@Rowan Multifamily Advisors. And Paul, I don't know if you'll share our contact info. I don't know if I should. Okay, perfect.
No,
Well,
I will.
I'll let you share it before I announce it on the airways.
Yeah, I'll share it. And to the guy who's the company's named after, or his mother, Rowan, what's the best way for people to get a hold of you?
Yeah, it's the same thing. We're very much phone people. I mean, you have to be as a broker. And so we've always found that, phone calls are a little bit more profitable for both parties than emails. So our cell phones are always open. We're always on them, always willing and ready to talk about the market or deals we have to offer and things of that nature. So we'd love to hear from you.
Yeah, I'll send out everybody's contact information on our webpage at the Old Capital Podcast, and you can get Rowan's and Colton's and Matt's telephone numbers or email addresses. The email is probably the best way of getting a hold of these guys, and they will respond back to you. Guys,
that'd be great. And Paul, yeah, like you said, we work as a team, all of us together. So if you work with one of us, you're working with all of us for the good or the bad. And so, yeah, we'd love to help.
Yeah, and we don't want to neglect our friends, Pete and Bradley and Connor and all of our friends over at Rowan Multifamily Properties. We certainly do appreciate that. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.